joining us for today's market briefing. In today's briefing, we will review what happened in stock and bond markets in 2022 and look forward at the challenges and opportunities in markets for 2023. When we look back at 2022, there are two metrics that investors will remember as being key catalysts affecting portfolios and everyday lives: inflation and interest rates. The inflation rate in the U.S. ran up to 40-year highs and was followed by an unparalleled streak of Fed rate increases, going further and faster than any time in modern history. These rate hikes shook the bond market and sent stocks into a bear market. Decades-high inflation and rising interest rates put pressure on global growth, and fears of global recession intensified. 2022 was an unusual year, with both stock and bond markets posting meaningful drawdowns. Global stocks and bonds lost more than $30 trillion in value in 2022. It is rare to see stocks and bonds decline together, as they are usually inversely correlated, but the extreme conditions in 2022 managed to do just that. Global stocks were down over 15%. Developed international stocks ended the year the top performing region, down 14.5%, while the US was down 18.1%, and emerging markets were down 20.1%. Fixed income securities were not spared either, with intermediate bonds down around 8% and high yield bonds shedding more than 11%. Commodities were the only winner this year, helped by inflationary pressures and the effect of the geopolitical issues in Europe on oil prices. With 2022 behind us, it's time to look forward to what's coming in 2023. Inflation and interest rates are likely to remain key topics going into the new year, but what are some of the opportunities and challenges in markets going forward? Stock valuations around the world contracted throughout 2022 as prices declined, but earnings generally held up. Although stocks are trading in a more reasonable valuation range now, it does not necessarily mean that they're trading at a discount. U.S. large cap stocks currently trade around historical average levels and are currently at a higher valuation than they were going into the COVID-19 pandemic. With global growth and profits slowing, earnings could face a tough headwind in the first half of 2023. This weakening earnings environment has not been fully reflected in earnings forecasts, but analysts are starting to reduce estimates for 2023. However, declining earnings could set up investors for better returns in the long run. Bear markets and recessions have historically proved to be good times to buy stocks. Another area of opportunity could be developed international stocks. On average, developed market stocks are trading at a considerable discount to U.S. equities. In addition to this valuation discount, these companies also produce a higher dividend yield than U.S. companies. Going forward, we think that income is likely to be a more important component of total return, and developed international stocks are one way to get increased income from an equity allocation. Throughout 2022, the main challenge for the Fed was managing interest rates in order to get inflation under control. There had not been a rate hiking cycle as fast and as steep since the Fed started targeting the effective funds rate back in the 1980s. Officials project more rate hikes through 2023, but markets are expecting a much slower pace than what we experienced in 2022. One positive of the rising interest rates experienced in 2022 is that investors are now getting paid to own core fixed income investments. Core fixed income remains a key component of client asset allocations, and the increased interest earned from bonds will contribute more meaningfully to total returns from here. Fed pivots and interest rates will be a key driver of the economy in 2023. Investors will be keeping a close eye and ear to the actions and statements coming out of the Federal Reserve. One key metric the Federal Reserve will be watching closely is the inflation rate in the U.S. As we mentioned at the start of this briefing, inflation hit 40-year highs in 2022 and put pressure on consumers and businesses alike. We started to see signs of cooling inflation during the fourth quarter of 2022, and markets generally responded positively on the assumption that lower levels of inflation would slow the pace of the Federal Reserve interest rate hikes. Headline inflation is coming down largely due to lower energy and goods prices, but core inflation is proving more sticky. The trajectory of inflation from here appears to be down, but the pace at which the declines occur remains a key component to Federal Reserve policy going forward. 2022 can only be described as a tough year for investors, with both stock and bond markets experiencing meaningful negative returns. The outlook for 2023 is still full of uncertainty, but we are expecting continued volatile conditions in the near future. Growth is slowing, and we have recently seen leading economic indicators turn negative, and the risk of a recession within the next 12 to 18 months has gone up significantly. For long-term investors, it is important to remember that in volatile times, the best course of action is often sticking to the investment plan you have in place. Remain invested and diversified, and use volatility to your advantage. Income from stock and bond investments is likely to be a more key component of investment returns going forward, and can help to provide a buffer through market volatility. Historically, recessions and bear markets have proved to be good opportunities for investors who are prepared to take advantage of the opportunities presented. From all of us here at RMB, thanks for tuning in. We hope you're able to join us for our next installment of Market Briefings.